back to the Options Academy. Well, searching for a strategy to use in times of low volatility conditions, one should make a note of the calendar spread. Now, a calendar spread is not a bunch of photos labeled Miss January, Miss February. But what is it? Well, an option calendar spread is a spread in which options of the same nature, all calls or all puts, are bought and sold in 2 different months, usually on the same underlying market. Often the calendar spread consists of selling an option in the closer months and buying an option in a farther away month and on the same side of the market. For example, if the Standard & Poor's is trading at the 1,000 level, you would sell at the 1050 call option within 30 days to expiration and buy the 1050 call option with 60 days to expiration. The intention here to take advantage of the faster time decay in the short-term option, which was sold. As you know by now, options lose time value faster as they near their expiration date. The purpose here is not to gain from the market moving in one direction or another, but rather to gain from the faster time decay of the short-term month. Remember, you have as much chance of predicting which way the market will move over a couple of months as the Weather Channel has correctly predicting conditions for the weekend. Possible, but not likely. We do not recommend placing calendar spreads in markets in which 2 different months may move 2 different directions. This may occur in markets such as the grain complex or the energy complex. Neither are psychiatric terms like the Oedipus complex, nor are they as disturbing. With grain and energy, short-term and long-term supply or demand can greatly influence the market. In such a scenario where the underlying asset moves in 2 opposite directions in 2 different months, the short option you sold may gain value against you, and the long option you sold may diminish in value, adding to your loss rather than offsetting it. Therefore, we think the most appropriate markets for the strategy are those in which different months move in tandem. Let's talk about calculating risks and reward on a calendar spread. It is virtually impossible to determine the profit and loss potential in absolute numbers. We may decide that the risk is limited, and we may implement guidelines to assess the risk and the potential profits, but no absolute numbers can be determined. Think of calendar spreads as the federal budget of options trading. No one knows whether the numbers are real or fantasy. This is because at the expiration of the short-term options, the long-term options will still carry some time value. Because of how difficult it is to predict and quantify this time value in absolute numbers, one can't be certain ahead of time what the exact value of the longer-term option is. 2 aspects are fundamental to the understanding and management of the risk in any given calendar spread. When dealing with a calendar spread in which the short and long strikes are the same, or when the long strike price is closer to the money than the short strike, the premium you paid will constitute the most significant aspect of the risk. This is because if the market moves against your position, your long option may gain almost as much as your short option, practically offsetting most of the loss. When dealing with a calendar spread, where the option you sold is closer to the money than the one you bought, the distance between the short strike, the one sold, and the long strike, the one bought, will be a major factor in determining the risk profile of the trade. The examples that follow and the next articles will illustrate several different types of calendar spread. Let's take a look at the time spread. In this type of a calendar spread, the short options, those sold, and the long options, those bought, are at exactly the same strike prices. This spread is initiated at a debit because the longer term option you buy has more time value and hence is more expensive than the shorter term option, the one you sell. Let's take a look at some real numbers. Please note that the examples that follow exclude any fees you may be required to pay. On Monday, September 17, 2007, the December S&P contract closed at $14.90. We would sell the October 1500 call and at the same time buy the November 1500 call. The October 1500 call settled at 36 points or $9,000. 36 times 250 equals 9,000. The November 1500 call settled at 49.2 points or 12,300. 49.2 times 250 equals 12,300. 49.2 minus 36 equals 13.2. 13.2 times 250 equals 3,300, excluding fees. Let's look at 3 scenarios. Let's start with the flat market scenario. From October 1st to October 15th, the S&P traded in a bullish fashion without much interference. Then came Monday the 15th and everything changed. The market reversed direction sharply and October 19th, expiration day for the October options, ended with a thud. Friday's closing bell saw the market approximately 40 points lower than Thursday's close, and the market settled at 1506. And as history has shown, it's not just Halloween that makes October the scariest month. Though the market was not at all flat during this time frame. At this level, our trade expired only 6 points away from the market level at inception, simulating the result of a subdued market. The October 1500 call that you sold expired in the money, and its intrinsic value was 6.0 points. The November 1500 call that you bought settled at 38.1 points. The total value of the spread at expiration then is 32.1 points, or 8,025. That's 32.1 times 250 equals 8,025. That's 8,025 minus 3,300 equals 4,725, excluding any fees you have. Now, let's see the bullish market scenario. Since expiration brought the market to its knees, it is impossible to know with absolute certainty what the results would have been had the market stayed bullish. It is only possible to estimate the result of this trade if the market indeed kept its bullish bias. Fortunately, we have a very reasonable way of doing that. To estimate the results of the trade under a bullish scenario, we will take an option chain with the settlement prices of the November options and move the entire trade down. The following will give you a clearer idea of what we mean. The 1450 call strike price is 56 points below the real expiration level. 1506 minus 56 equals 1450. It is 56 points in the money. If the market would have been bullish and expired at 1556, 50 points higher than it did in reality, the November 1500 call would have been 56 points in the money. It is reasonable to assume then that the value of the November 1500 call would have been similar to that of the November 1450 call. Both are analyzed at 56 points in the money. And yes, we really can't live our lives without assuming some things as fact, like the sun will rise tomorrow and the weather will change with the seasons and at least one celebrity will go into rehab after getting arrested each week. Let's examine the October 1450 call we sold versus the November 1450 call we bought and compare their values. On Friday, October 19th, the November 1450 call settled at 73.1 or 18,275. 73.1 times 250 equals 18,275. The October 1450 expired, as we know, with an intrinsic value of 56 points or $14,000. The total value of the spread then is 4,275, excluding any fees. Since the premium paid at inception was $3,300, we can clearly see that even at 50 points in the money, this calendar spread would have been winner to the tune of approximately $975. Let's examine one more scenario in which the options expire even deeper in the money. For this exercise, we will move the entire spread 75 points down and we'll use the 1425 October call versus the 1425 November call. November 1425 call settled at 93 points. The October 1425 call carries a value of 81 points, bringing the total value of the spread to 3,000. 23,250 minus 2250 equals 3,000. It is here, 75 points in the money at expiration, that we see the spread turning into a losing one. Though under these circumstances, a 75-point move, or approximately 5% within less than a month, is nothing to be ashamed of. And considering the first and second scenarios, one could again see why many traders are attracted to this type of trade and its risk-reward profile. And finally, let's take a look at the bearish market scenario. Using the same logic we outlined above, we can try to deduce potential results from the trade under a bearish market scenario. We can do that by moving the entire spread up on the option chain and using strike prices above, where the market actually expired. The first thing we will examine is its potential loss if the market loses ground drastically and enters a sharp downward momentum. Under this scenario, both options would lose most of their value, and while the November call option would always retain some time value until expiration, the spread between the options would narrow, representing a loss. For example, in order to estimate a loss in the unlikely but nonetheless possible event of a 13%, approximately 200 S&P points correction down, we would look at a strike price that are 200 points above the 1500 strike price. Remember that this example relates to the time of writing. On Friday, October 19th, 2007, the October 1700 call expired worthless, while the November 1700 call settled at 0.1 or $25. 0.1 times 250 equals $25. We can then deduce that if we sold the October 1500 call and bought the November 1500 call, and the market was trading 200 points lower near expiration, the spread between the options would have narrowed. This, in effect, would represent a loss of the complete premium we paid, $3,300, excluding any fees. If you're humming along to that loss, the tune is probably the funeral march. It is worth noting that under this scenario, instead of closing the long November call option, we would hold it in case the market turns around. For the risk of losing the 0.1 points, $25, it is worthwhile to hold the call. Now that we know the worst case bearish scenario, let's take a look at a smaller volume bearish move. We'll consider strike prices that are 25 points above the 1500 strike price, which will represent a downward move of 25 points, or a little more than 1.5% from the market level at inception, 1490. Just to refresh our memories about the process, we sold the October 1500 call and bought the November 1500 call on Friday, October 19th. The S&P market settled at 1506. The November 1525 call, which is 25 points higher than our 1500 call, settled for 24 points, or $6,000. 24 times 250 is 6,000. If the market were to settle 25 points lower than it did in reality, our November 1500 call very likely would have been valued near the same as the November 1525 call. Since the October 1500 would have expired worthless if the market settled at 1481, 1506 minus 25 equals 1481, our profit on the spread is the premium of the November call we own, 6,000, less the initial debit we paid to enter the spread, 3,300. In this case, our profit would have been approximately 2,700. 6,000 minus 3,300 equals 2,700, excluding fees. Repeating the same process to estimate results on a 3% downward move, 50 points, we would look at the November 1550 call. Again, since the October 1500 call would have expired worthless, our profit or loss would be determined by computing the value of the 1550 call to our original debit. The November 1550 call settled at 13.6 points, or $3,400. 13.6 times 250 equals 3,400. For a small positive balance, suggesting once again that even under some adverse conditions, the calendar spread offers a strong inherent risk management mechanism. Not only that, but when you make money under adverse conditions, you can gloat about it to your friends who didn't. This concludes our presentation of the time spread. It is important when trading options to be keenly aware of the volatility levels in the market and to be pragmatic as to the choices of strategies. Many options traders avoid writing options when volatility is low because a sudden increase in volatility might raise the value of the options. The time spread may very well be an alternative to the sidelines, allowing you to continue living and breathing the market while keeping your exposure low. Here's to your success, and remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. We hope to see you soon.